Hello guys, welcome to i-tutor Academy. In today's session, we will start with the Unit 8, that is MMBC 006, subsection 5, Objectives of Pricing Policy. Before a marketer fixes a price, he should keep in mind certain basic consideration. You just rewind the Unit 8 first subsections till 4, it will be more clear. And the price policy he adopt is closely related to his other policies like a production program, advertising policy and selling method. And example also here just mentioned. And if marketing manager is to make effective pricing decision, he should be clear about the firm's long-term marketing objectives for the entire range of products and services. If the firm is interested in increased market shares, it would have to resort to penetrating pricing. If it is interested in short-term profitability, it may have a higher price even at the expense of sales, volume and market shares. So here is one column: marketing area, marketing objectives and pricing implications. So one example is there is marketing area is product. So marketing objective is to improve quality acceptance. So higher cost is equal to price increase or lower profit. Okay. So this is, and advertising and promotion is there, distribution areas are there, consumer or users area is there. So all areas have different objectives and pricing implication also change. So you just go through your IGNOU study material. And next one is consumer psychology and pricing. Sensitivity to price change will vary from consumer to consumer. In a particular situation, the behavior of one individual may not be the same as that of the other. Some important characteristics of consumer behavior as revealed by research and experience are detailed below. So one, from the point of view of the consumer, prices and quantitatives are prices, whereas product quality, product image, customer service, promotion and similar factors are qualitative and ambiguous. It is easier to speculate about what consumers would do if prices raised by 5% than if the quality improved by 5%. And next one is price constitute a barrier to demand when it is too low just as much as when it is too high. And above particular price, the article is regarded as too expensive, and below another price as constituting a risk of not giving adequate value. And price inevitability enters into the consumer's assessment of quality. There are two reasons for this. It need expert knowledge and appropriate equipment to test the quality or durability of some particular products. And a customer tend to look upon price itself as a reasonably reliable indicator of quality. What is costly is thought to be of a high quality. A higher price is ordinarily taken to be a symbol of extra quality or extra value of extra prestige. This is especially true of durable consumer goods, which are very often differentiated, at least psychologically, through branding, packaging and advertising. In such cases, the sales of certain goods could be stimulated more effectively through higher rather than lower prices for two reasons. The higher price increases the snob appeal of the goods, and the higher price creates confidence in the customer that he is getting good quality. To conclude, in many cases, the price is used by the prospective customer as a clue for sizing up the quality of the product. This price quality association is well established. With rising income, the average consumer becomes quality conscious, and improvement may therefore lead to an increase in demand. And consumers may be persuaded to pay more for heavily advertised goods. A fame's size, its financial success, and even its age are often perceived by consumer as measures of quality. In a comprehensive survey of consumer consciousness, it was revealed that the basic postulate of the demand theory, the consumer has an appropriate knowledge of market price, was not fundamentally wrong. The following type of consumers are most likely to perceive price as an indicator of quality: persons trying to achieve status, occasional consumer who is not knowledgeable in a product area. purchase of a camera, and the buyer who is impressed by the importance of quality but has difficulty in identifying it. An experimental study in India showed that more than 60% of the respondents revised their rating of ready made shirts after knowing their prices, indicating thereby that price information does have a significant effect on quality perception. To conclude, higher prices that increase consumer readiness to buy may sound uneconomic but may not be unrealistic. The price quality concept has equal relevance to new product pricing. The lesson from this discussion is that the producer has considerable flexibility in pricing his product provided he can create a psychological image of quality. Next is pricing of industrial goods. For many consumer product buyers are not usually aware of the prevailing prices. Products falling in the category of luxury goods and items not frequently purchased would constitute such goods. Consumers, of course, are usually aware of the regularly purchased items like groceries and the allied. On the contrary, buyers of industrial goods tended to be price conscious. They are keen to check what they get for the price they pay. They also tended to act more rationally than an average buyer of consumer goods. Their knowledge of market is more intensive and exact if not perfect. Very often, the buyer of an industrial product knows or at least can make a guess of the cost of manufacture. The product differentiation is easier in industrial goods than in consumer goods by providing better service in connection with delivery, use or installation, and building a reputation for reliability or quality of workmanship. Moreover, product differentiation results much more from product differences that generate provable claim. Branding therefore plays a much less important role in the marketing of industrial goods than in the case of consumer goods. Price leadership is a very common phenomena in the industrial goods market. The price elasticity of the demand for an industrial product would depend to some extent on how important its price is in the general cost structure of the using frame. It is represent a significant element. A reduction in price may lead to substantial increase in demand. Okay, and pricing during the life cycle of a product. Many products generally have a characteristics known as perishable distinctiveness. This means that the product which is distinct when new degenerate over the years into a common commodity. The process by which the distinctiveness gradually disappear as the product merges with the other competitive product has been rightly termed by Joel Dean as the cycle of competitive degeneration. The cycle begins with the invention of a new product and is often followed by patent protection and further development to make it sellable. And this is usually followed by a rapid expansion in its sales as the product gains market acceptance. The competitors enter the field with the imitation and rival product, and the distinctiveness of the new product starts diminishing. And here is one figure is there is an introduction, growth, maturity, saturation, and decline. This is the product life cycle period. Okay, and it may be noted that the product may begin in new cycle or revert to an early stages as a result of discovery of new uses, the appearance of new users, and introduction of new features. As the distinctiveness of the product fades, the pricing discretion enjoyed by their producers gradually decline. This is what happened in the case of many products like transistors, radios, pagers, Walkman, audio system, mops, etc. Throughout the life cycle, changes take place in price and the promotional elasticity of demand as also in the production and the distribution cost of the product. Pricing policy therefore must be adjusted over the various phases of the cycle. Let us know the pricing policy in the pioneering stage and the maturity stage of a product. Pricing a new product. The basic question is whether to charge a high skimming, that is initial price, or a low penetration price. If a skimming price is adopted, the initial price is very high. The policy may be held for varying period of time indefinitely if the product enjoys valid and defensible patent protection. But usually it is not longer than the time necessary for competitors to study the product's usefulness, to decide what to do about it, and to prepare for making it a period ranging from a few weeks to as much as 2 years. And here is again the chart is here, you just go through it, and there is a saturation phase also in between the maturity and decline phase. Okay, a high initial prices, skimming price, that is high initial price, together with a heavy promotional expenditure may be used to launch a new product if conditions are appropriate. So here is an example, you just go through this example from your IGNOU study material. And a low penetration price also there, in certain condition it can be successful in expanding the market rapidly, thereby obtaining larger sales volume and lower unit cost. It is appropriate where sales responds quickly and strongly to low price. There are substantial cost savings from volume protection. The product is acceptable to the mass of consumers, and there is no strong patent protection, and there is a threat of potential competition, so that a big share of the market must be captured quickly. The objectives of low penetration price are to raise barriers against the entry of prospective competitors. Change in price. Reduction in price. A reduction price may be made to achieve the following objectives. And the example also share here. You may observe and analyze the price revision and the possible reason for various product or categories and services in the current business and competitive environment of different firms. Next is increase in prices. Very often a company might face a situation where cost may have increased, and it might wonder whether to increase prices or not. The decision would depend on how demand would be affected by such an increase in price. In fact, prices are usually increased whether the market demand is strong and the business is having a boom. Next one is nature and use of price discount. There are two popular type of discount. There is quantity discount and cash discount. What is quantity discount? Quantity discounts are price reduction related to the quantities purchased. Quantity discount may be related to the size of the order being measured in terms of physical unit of a particular commodity. And one important objective of quantity discount is to reduce the number of small orders and thereby avoid the high cost of servicing them. Quantity discount can facilitate economic size order in three ways. A given set of customers is encouraged to buy the same quantity but in bigger lots, and the customer may be induced to give the seller a large share of their total requirements by giving preference over competitors. And small size purchasers may be discouraged and bigger size customers may be attracted. In many cases, discount become a matter of trade customers. Next is cash discount. Cash discounts are price reduction based on promptness of payment. An example of discount can be 2% off if paid in 10 days. Full invoice price in 30 days. In practice, the size of cash discount may vary widely with changing time. Next one is product position and price. By positioning, we mean the way a product is viewed by the customers in comparison with a similar product. All aspects of the marketing mix must be coordinated to place the product in the right position in the market segment aimed at the right time. Price is just one element of the marketing mix, and it must reflect the production position in the market. Non-price competition. The basic aim of non-price competition is to alter those characteristics of the product other than price which influence the decision of the buyer. The various forms of non-price competitions are advertising and creating brand loyalty, changes in the quality of goods and services, prompt deliveries, free gifts and contests, and better after sale services. The more complex the product, the greater the characteristics which could be modified in response to customer taste or as a result of change in technology. And summary of this chapter is here. Pricing is an important element of the marketing mix. Pricing is affected not only by the cost of manufacturing the product, but also by the company's objectives in relation to market share and sales, the nature and intensity of competition, stages of product life cycle at which the product is currently positioned, nature of product, whether a consumer or industrial product, and if the former, whether it is a luxury or necessary. Before making any pricing decision, it is important to understand all these factors. There are various methods of pricing. The four most commonly used methods are full cost pricing, pricing for a rate of return, going rate pricing, and customary pricing. And before designing the pricing strategy, in which the choice is between penetrative and skimming price, the marketer must fully understand the connotation of price to a customer. In some, a reduction in price may lead to an increase in sales, while in other cases it may not. This is especially true in case of industrial product, where the buyer may be more concerned with the quality, reliability, delivery schedule, and after sales service of the product rather than merely the price. Rather than a reduced price, what may be more relevant is price discount in the form of quantity or cash discount. Self-assessment exercise also here in this chapter. So here there is an 10 questions is there, so you just try to do it one by one, and also parallelly you just do your assignment, and self-assessment questions also equally important for you. It will help you for your term and examination. In between any doubts, you can contact anytime on our contact number also, otherwise you can email us. And thank you so much.
i-tutor Academy presents IGNOU MBA complete syllabus coverage classes for individual students, semester-wise subject with online and flexible timing. For more details, contact on +916 238 21785.